Morning, everybody. I think it's time we can start. It's 11 o'clock. We've got a good come up. Thank you and welcome to everybody that's joined us in the boardroom here, and also everybody that's online. First of all, just apologies for Megan and the Gold Rush team not being able to be with us here today. They've just come back from China, so the guys have just landed. But I think it's a good thing that we have them online. Before we carry on with the meeting, what I am going to do is just read out some prepared comments, as we always do. So we share the information with everybody, and then we'll open for Q&A. We'll just need to get the admin sorted so that we can unmute you as you want to ask your questions. Or if you want, you can also just put it in the Q&A over there. So today's meeting is the final one of this kind. From 14 August, the participating preference shares of RAC will be trading as Gold Rush Holdings Limited under the alpha code GRSP. And then Gold Rush Holdings will be the listed holding company for our 59.4% share in the Gold Rush Group Pty Limited. Now, with the name change, which reflects the economic reality of the company, also comes an accounting change, which will see Gold Rush Holdings present consolidated accounts going forward. So we expect that for the September half-year numbers will be the first time we'll do consolidated accounts. Beyond this, nothing else really changes. We believe the current structure of RAC/Gold Rush Holdings serves all parties well. The responsibility of the executives of Gold Rush Holdings, which is Pete and I, will be to see to all affairs relating to the company's listing, governance, as well as guidance on capital allocation in the broader Gold Rush Group. And the management team, which is Megan, Michael, Katlego, all the other guys, they will remain responsible for the day-to-day operations of Gold Rush, which is a job that they've done spectacularly well since they founded the business. In terms of an update for the first 4 months of trading, the bingo division traded slightly lower than the same time last year, with a number of active customers slightly down while the average spender stayed constant. The limited payout machine division operated less machines. We took out a number of machines from underperforming sites, and those are in the process of being reallocated. But an increase in aggregate gaming revenue per machine has meant that the total revenue for this division in the first 4 months is in line with the same time last year. The sports betting division is trading in line with the previous 4 months as well, despite the unusual lumpier revenue pattern. And the online division saw revenue grew strongly compared to the same time last year, continuing the growth trajectory that we've experienced in the last year. So if you put all of this together in aggregate, the revenue for the group is up 5% for this period from compared to the same time last year. And on the cost side, Mergs and the team have managed costs accordingly, and we've had some added relief from reduced diesel costs over this period. So with that is the end of our prepared remarks, just to give you an update of where we are, and we'll open the floor for any questions. If you want,
you can raise your hand or type it in the Q&A box.
Dirk, I'm just gonna. Dirk van Vlaanderen's got some questions. Dirk, please go ahead.
Yes, thanks. Hi, Megan, and hi, Jan. Just maybe to start, I mean, with load shedding, I think it would be interesting to see, with the alleviation of load shedding, if you've seen any change in consumer behavior at your bingo sites, particularly, Megan. And yeah, I mean, maybe commenting on footfall and spend would be useful. Thanks.
Mergs?
Yeah, cool. Jan, whether step in or are you going to refer the questions to
me? No, please carry on.
Yeah. No, fantastic. How's it, Doug? Yeah, so interesting enough is that, even after load shedding ended, we didn't see a material comeback of customers, back to retail stores. So, hopefully load shedding pretty much, we hope, came to an end in the last 3 months. Hopefully it won't continue going forward. And, it's something to see where the customers are transgressing back into the retail environment. But, what we have seen over the last couple of months is that our active customers from a retail environment has slowed down slightly, but the average spend has, stayed consistent over the last quarter. But obviously, we think a lot of those customers now have transgressed into the online environment. So right now, we're probably sitting between 60 and 70,000 active customers in our retail environment, and online's jumped in the last year from about 20,000 at the start of last year to just over 30,000 active customers in our online environment. So we definitely see that migration from the retail into the online space. And I think, we've seen this, around the world. Whenever the guys have introduced the online, is that you will see a migration of customers. And, one of the benefits that we see is the ability to leverage off our, retail environment. Because, inadvertently, what we've created is that you can't drive 30 kilometers, in KZN, Gauteng, or Eastern Cape without entering a Gold Rush property or a Bingo Royale property. So, we expect to leverage that quite a bit in terms of keeping our customers within our ecosystem.
Same. Thanks, Megan. Can I maybe follow up? I mean, what is the overlap of your retail customers to your online customers, and how's the progression of a kind of, I guess, a loyalty scheme or a card scheme going to try and capture more of them?
Yeah, so I think we can actually leverage off that quite a bit, because right now we've only seen about a 5 to 10% migration from our current retail environment into the online environment. That means the majority of the customers we attracted from an online perspective is outside the Gold Rush ecosystem, which for us is a phenomenal result. In terms of our loyalty system, we expect to launch a group-wide loyalty program that incorporates our online and our retail by the start of the second half of this financial year. So right now we're operating a loyalty system just for online and a separate loyalty system just for retail. So in the second half of this year, we're very excited where we can actually roll out a group loyalty system that incorporates online and our retail customers into one loyalty platform. So yeah, we hope 1 October, but let's see how things go.
Great, thanks. I'll let others ask some questions.
Sure, Mark.
How's Megan? Sad you couldn't be here, but I just want to ask a follow-up question on the online. VIP is also a big thing if you look at Soho, if you look at Sun, and internationally as well. Are you looking to also have a VIP strategy?
Sorry, but just to confirm, the question was just about the VIP strategy, right?
Yes.
The top-end customers. Yeah, no, definitely, and that's a primary target area for our customer base as well. I think pretty much the entire gaming environment, also follows the 20/80 rule in terms of 80% of our revenue comes from about 20% of our customer base. And that'll be focused a lot around those VIPs, but in general, not just the VIPs, our entire customer base as well. I think that, we've got something very unique that, we have to offer, in the online environment, and that's basically our retail presence as well. So we think we'll be able to offer a lot more to online customers than retail customers. Other online platforms, there's very limited offers in terms of what they can offer you, because, we feel that there's still a substantial portion of customers that enjoy the retail space and play online from a convenience perspective. And that's where we can merge that convenience factor from online and retail, because if you've got a VIP customer playing online, we've also got a retail site as well that's very close to your proximity as well. So we're going to leverage quite a bit of that in the upcoming year.
So would you say your product at the moment is mainly mass markets? Is that how you look at it?
I don't think it would be mass market. I think, we've got a very targeted segment in terms of how we segment our customers and how we market to our individual customers. So every part of our customer segmentation has a different strategy aligned to that segment. So we've got a specific strategy that targets our high LSM customers, our VIP, which probably makes up between about 3,000 to 10,000 of our customers. A different strategy that targets our platinums, which probably make up about 30 to 40% of our base, and a different strategy that targets, the majority, 50, 60% of our base. So it's a different strategy, different segmented, targeted based on where you sit in that, in that segmentation.
Good. Yeah, thanks. Balalam Herzog, I think you've got your hand up.
Good morning, James. Thanks. Megan, sorry, just touching on those comments you made about bingo customers seemingly not returning post load shedding no longer being an issue? I mean, it sounds somewhat concerning, to be honest. Do you think there's been a permanent migration from bingo to online, which occurred during load shedding, and people come to enjoy the convenience and no longer see the need to visit a bingo hall? Or, I mean, what's going on? I mean, to the best of our understanding, load shedding was largely attributed or as the source of customer loss in bingo over the past, let's say, year or so. It sounds a bit concerning that customers aren't returning now that load shedding is no longer an issue.
Yeah, so it isn't a material change. So in terms of the active customer base, we've seen pretty much between a 1 and a 1.5%, decline in active customers. And, if that's the decline in active customers that's moved onto a retail base, I think there we're quite comfortable. Because what we've gained from an overall customer base versus the movement of the 1.5% drop in retail, I think that's pretty much expected. And I think better than what we actually expected in terms of, of that migration from retail to online. I think if there was no migration, it would be, impossible. I think what would concern us if we saw 20 to 30% of our customers migrating to online. I think we're very happy if we're seeing that 1 or 2% of our customers have dropped. But what we've gained from an online perspective is significantly more than the 1%, active drop in the retail space.
Okay, and then just a second question, if I may. I mean, my impression of the online space is that it's largely a marketing budget-driven game, right? So, I mean, can you compete with Hollywood bets, etc., with the guys with them spending massive amounts of money on marketing? I mean, do you have, coming from let's say from the market share that you currently have, and sure, you've got the physical presence, and that does maybe give you some benefits in terms of customer acquisition. But how does a smaller online player effectively compete against the giants of the industry?
No, it's a great question. And it's something that we wouldn't want to go, pound for pound, against a Betway or Hollywood, especially the size of their marketing budgets as well. And hence why our strategy is not to go pound for pound from an advertising perspective, but actually leverage off the benefits that we can offer to our consumers. And, effectively what we can offer to our consumers, what, many of the other, online guys cannot offer, is the ability to reward our clients in retail and online as well. So effectively, if you're an online customer, for example, in KZN, and you're playing with an online environment, the best you can get offered is pretty much, a free tickets to sporting matches, concert matches, probably some offers back in bonus matches, and it's very limited to that amount. And everything else pretty much relies from an advertising perspective. Whereas we feel where we can leverage is the ability to reward our customers in retail and online. So if we've got an online customer, is you have the ability now for them to reward them in store, but they're not driving 50 to 100 kilometers away to get that reward, right? That's the benefit we have. Is we're now sitting within their retail community. So if we actually reward our customers, and we're currently doing it now as well, and it's been marginally successful in the last quarter, where you actually have online customers that have the ability to join into retail promotions, to join into retail incentives. And we've seen now we've been attract more customers from our online space into our retail environment, which has been great. So definitely not pound for pound from an advertising perspective. And we think we can carve a very nice niche out in the market for ourselves.
So, hello, Megan. If I can just add to that, the strategy on the online side isn't to try and have the biggest revenue. The business is run with a proper profit objective. Megan will tell you that every month when we go through management accounts and strategy, the idea is that the online business can only grow at the pace that it can afford itself. So there's a definite EBITDA and EBIT is the same thing in this business, but there's a definite margin set, and the business have a specific marketing budget that it spends, and we stick to that budget. So the growth that the online business have experienced in the last year and a half or 2 years are all internally generated. I mean, on a simple level, it's how much you spend to get a new customer and how much do they spend with you over time. And if that ratio goes in the right way, then the online team has more money to spend on marketing. So the idea here is to run a profitable business on a return on capital basis, not to have the biggest marketing spend. And Mergs and the online team have got that right in the last 18 months. Obviously, the guys will have to adopt over time. Tactics change, but it's I think it's important just to make that point.
Okay, great. Thanks a lot, guys.
Sure, Mark.
Yes, Mergen, I just want to ask about the margins of the different segments of the business. The bingo division, let me start with the LPM division. I assume that because of the way the business is set up, it's holding its margin where the bingo division is not. Would you agree with that? And can you add some color to what those margins actually look like?
Oh, so right now, with the increased ad spend from a retail environment, we're probably hitting between 20 and 25% from a bingo perspective. On the LPM side as well, very similar margins between 20 and 25%. The online business has significantly increased their margins over the last year. So, effectively, they went from, loss making to, I think, in the last quarter, averaging about between 15 and 20%, EBITDA margins as well. And, we expect that as that business starts getting more and more traction, we'll start seeing better margin returns out of the online business, as well. Because, a large part of the business is variable cost, and a very small portion in the online space is fixed cost. So we're seeing a lot of return from a margin perspective as that online business starts growing. And then from a betting business, unfortunately, there we're probably sitting at about 5 to 10% EBITDA margins from a retail perspective. Retail betting, I think we've got a nice niche in terms of the number of stores out in the market. We're probably now only going to expand that business if a good opportunity comes along, which we are actually looking for, but it's not where we've now going to go and open up a 5-store or 5-teller to 10-teller store now. So our strategy's changed completely. Is all stores now are going to be sitting at plus 40-teller stores. If we don't find that opportunity, then we hold the current licenses that we have now. So overall, in a group perspective, we're probably sitting at between 20 and 25% EBITDA margins.
And if we look at your sustainable EBITDA that you did this year, so this is first sustainable EBITDA of 344 million. It would imply a run rate of about 188 million for H2. H1 24, you did 156 million. Where would you think you'll lie going forward, towards the 180 mark or more to the 160? I know the update that you gave us for the first 4 months, revenue is up about 4%, but it doesn't really give us a good idea of where those the EBITDA will be going forward.
Well, hopefully we're closer to 200 million. But normally we find that the second half of the year is significantly better than the first half of the year, especially coming into, Christmas and all the holiday seasons in December. And that's pretty much what you'll see across the entire entertainment and tourism space as well. So definitely we find that the second half of the year is definitely better than the first half of the year. We've seen that last year and all previous years, as well.
Derek, please carry on.
Yeah, thanks, Mergen. Just another question. I mean, I guess if we take a step back for Gold Rush strategy, which if we go back 5 years was investing in bingo sites, waiting for those sites to ramp up to where mature sites were trading, and somewhere in the middle of that we had COVID, which kind of derailed, and then we had load shedding, which derailed again. I mean, what are you seeing on the newer sites? Are those trading up to the more mature sites, or is it just the case that the mature sites are coming down? It's a bit difficult to see how the portfolio is, I guess, performing from the newer ones to the older ones. So maybe some light on that would be useful.
So from a new site perspective, is what we find even historically as well. It normally takes between 2 and 3 years before a bingo site matures. So the sites now that we've opened up, recently in the last couple of years, we've seen significant growth in those, in those sites. And what's under pressure is obviously the mature sites that are slightly behind from a revenue perspective. So hence why you have that amalgamated growth of about 3%. So definitely a lot of the strong growth is coming from the newer sites that we opened up in the last couple of years, with the more mature sites probably being a couple of percent down from a like to like perspective. Sorry, Doug, the second part of the question as well.
No, I think that's helpful. I mean, I mean, the other, maybe just a follow-up to that is then, I mean, what is the sort of capital allocation strategy within bingo now? I mean, it sounds like this is a lower growth proposition than maybe you would have thought 5 years ago. So how do you think about capital allocation in this division?
Cool. So definitely in terms of the returns overall, we're still seeing that 20-25% excess return in from a bingo perspective. So from a new site perspective, definitely good opportunities there. We have now 5 new licenses that we acquired and was awarded in the last year or so, and that will be rolled out in the next 12 months. But I think from that perspective is we're quite comfortable in terms of still getting a good return out of the current bingo properties. Is the sites that are under pressure is our very, very mature sites, and they're a couple percent down. But again, those sites were doing very well, pre-COVID as well. So those top end sites are really performing really well. So them being, a couple percent down, it's still giving us a very great, return on our capital. So I would definitely want to continue investing in the bingo segment, especially when it comes to rolling out new properties as well and new opportunities. Obviously, there's certain sites we would stay away from because not all bingo sites are the same. You do have your good performing sites, your bad performing sites based on where these sites are located. All the time, we do have some offers to acquire bingo sites based on the location. And a lot of times we even say, no, we don't choose to acquire those sites because we don't think those sites will, perform just purely based on the locations of those sites.
Sorry, Derek Mergen, if I just can add to that, remember a bingo site these days costs sort of 10 million rand to kit out, and the machines are all rented. So the actual capex that goes into opening a bingo site is quite low and quite light. The other thing is, in terms of making a big move, moving the needle in a big way, adding 2 or 3 more sites in a year on top of a portfolio of 36 doesn't make a big difference. I mean, the truth is that in order to grow revenue and profitability in the bingo business, we need revenue and profitability in the existing sites to grow. And part of that is to relocate. So for instance, last year, Atterbury was relocated to Sandridge. That site before the Sun International Casino came into Times Square, I think that was running at over 6 million rand a month in revenue. And by the time we moved it, that was 4 or 5 years later, Mergen, that was down to 2 million rand a month in revenue. So by optimizing the existing portfolio, we need to generate sufficient revenue and returns out of the existing capex we've spent.
Okay, so I mean that's the top line, and Mergen, you've always been very active on the cost base, and I think even through COVID, looking at new ways of working. What else can be done on the cost base? I mean, what sort of inflation are you seeing across some of the big cost buckets, or hopefully deflation?
Yeah, so I think as well we've done quite well in terms of managing our costs across the group, especially on the bingo side. So some of those costs that we can't control very well, it's a little bit out of our control, is, for example, property leases with retail now. That makes up a big portion of our inflationary costs. So they obviously, where our benefit lies in the sense that the amount of footfall we pull to these shopping centers. So we have a little bit of leverage there from a inflation perspective in terms of rentals on the properties. All other expenses we manage quite well. A big cost base that we have is our machine suppliers. And, there we do quite well as well. Because of our size in the market is we do very well in terms of negotiating those deals. And many of those deals are based on revenue participation as well. So the more we go, revenue is all linked to revenue. So that helps us control that expense as well. So I think overall across the group is we're doing quite a good job in terms of, managing our operational expenses.
Okay, thanks. I'll let some others ask questions. Thanks.
Can I just follow up on that question? On that 188 for H2, were there any once-off costs or savings or reversals that are in that number? Or H2 next year, we should expect something around the same number?
I think there was some once-off cost, sitting in there in the second half of the year, primarily relating to our gain of acquisition of the new business that we acquired. But generally, overall, is excluding the once-off items of the gain of acquisition, is we generally see a growth in the second half of the year compared to the first half of the year as well. So the second half generally significantly outperforms the first half of the year, even excluding the once-off items.
Thank you.
Okay, we've got some questions on the online side. I think Michael de Villiers wants to know what the rationale for remaining listed is when liquidity is low and seemingly no need to raise capital. That's a very good question. I think the market is telling us right now, and I think it is probably the case for most investment holding companies, is they don't want to provide us with any more capital. That's why it's trading at a big discount. They don't want us to invest anymore. That's why it's trading at a big discount. So we need to take that message on board and work with it. And I think we have taken that message on board, and we are seriously looking at ways to unlock the value over time, because the current situation is not, it benefits nobody. Do you want to add to that, John?
Yeah, look, RECM and Calibre was started as a aggregate investment holding company, and then Goldrush became the dominant asset. And many of our shareholders said it would be nice if we can have Goldrush listed on its own, which is basically where we have ended up now. So, I mean, we, the business need to perform and generate and give returns to shareholders. It is now a standalone business, and you've got full access to the management team and the financials. So from a structure point of view, there's not a hell of a lot more we can do. The liquidity or lack of liquidity, my experience in the market is, at a certain price, there's enough liquidity, and when things are bad, the price will be lower, and when things are better, it'll be higher. So obviously, as management of the business and the structure, we need to keep on doing the right stuff. In terms of capital allocation on the holdings level, we're looking to reduce the debt on that level as fast as we can, except if we can use some of the money to buy back shares at an accretive value. And inside of Goldrush Group, Mergen use capital allocation, and we're very much involved in that to make investments where there's high returns on that capital. That's what we focus on and have to do. The rationale for being listed, I guess the point is there's many people on the call that have been shareholders of the business for a long time, and they deserve to get the returns that they will get from being a shareholder in the business.
Yeah, so we're working hard on generating those returns. Whether the market wants it or not, I mean, that's a message we will have to take on board over time. We have simplified the structure. We've unbundled all the other assets out. We have one asset left, that's Goldrush. It basically is becoming an operating business. And let's see how the market treats that listing. And again, we'll take on board the message that the market is giving us.
Okay, I hope that answers your question, Michael.
So, and then, Michael, if it doesn't, you can follow that up with another question. In the meantime, we'll move on to Dale Feinberg's question. Mergen, what did you learn on your China trip?
You've only got 5 minutes for that.
Yeah.
What did we learn on our China trip?
Maybe you want to say, yeah.
So we can't really talk about, what we went to China, for at this point in time. So, but, in general, what we've learned is that, I think we are far behind what's happening, in the east of the world from technology perspective. I mean, I was quite, shocked when I got into the country, just from a technology perspective, from a gaming perspective, how far ahead they are from the rest, of the world. So, definitely, I think, just in terms of that, omni-channel experience, it was great learning from, our colleagues out in China. I mean, they had a joke that, they said quite often, and it became a normal thing for us, is that, they were talking about, the omni-channel experience and player journeys, 10 years ago. And now the industry has moved far on from that. So I think it was great, the learning initiatives in China, what we came back with. And yeah, hopefully that, that continues.
So I guess the bottom line is you're looking to integrate the stuff you've learned and discovered into the business.
Mm.
Well, I hope that answers your question. That's all from the online side at this point.
Q&A. Dirk, please go ahead.
Sorry, I realize I'm dominating the call here, Megan, but while I have your attention, maybe you just talk about the balance sheet of Goldrush. And I mean, it hasn't been it's free cash flow looks to have been very good. Just your priorities around capex, debt, dividends, and also maybe just an indication of what you think a sort of reasonable level of run rate for capex is for the business. Thanks.
Okay, cool. So, so right now I think we are quite comfortable. So debt to EBITDA was, just under, 2 times debt to EBITDA when we end of the year. We've always seen a, drop going into the first quarter, and, by the end of the year as well, that ratio will improve as well. So we've seen a consistent, improvement in those ratios coming from, COVID, post-COVID, and actually even before COVID till now, is we've seen a significant increase in all those, in all those ratios. So from a bingo perspective, is we're probably going to spend between 30 to 50 million rands, a year. That's primarily on optimizing site locations, renovating sites, and keeping those sites up to the highest levels as well. I think the one thing that we don't want to do is let our properties dilapidate in terms of, what our customer experience is. So I think they're just keeping our properties right up there in terms of, from a customer experience perspective, is very, very, important for us. Normally when we go in and, we fully renovate a site, from start to finish, that means it looks completely different to the customer as they walk in. Probably costs us between, 3 to 5 million rands, to completely renovate a site. So you'll find that we spend less money on general maintenance capex, and we find that when we go into a site, every 5 to 7 years, is there we choose to do a full revamp of the entire site to refresh the look of that site. So we probably look to expend between 30 to 50, including relocation, optimizing sites, and keeping sites fresh, as well. On the LPM side of the business, is again, we expect to spend just about 50 million and more on acquiring LPMs. There's quite a bit of capex that needs to be spent on the LPM side, because remember, we only right now have about 2,600 LPMs out in the market, and we've got licensed up to 5,000. So we've got to now still invest and roll out another 2,500 LPMs out into the market, which for us is great because that'll obviously give us good returns as well from an EBITDA perspective, but it'll also need additional capex investment as well. But, that capital investment from the LPM side drives EBITDA and bottom line growth as well. So it's not additional capex that doesn't drive, revenue growth. That LPM investment, specifically drives, EBITDA and bottom line as well. And on the retail and online side, there's very little capex spent on those two sides of the business.
So if I add that up, it's 80 to 100 million a year.
Yeah.
Look, perhaps just the one comment there, Megan will tell you we argue about this regularly. the rollout of the LPMs happens only as long as the return on the machines are above our minimum hurdle rate. So it's not just a blanket rollout as many machines as we can. Again, we understand what revenue a machine must make compared to the cost of the machine. And as long as the team manages it, at the right levels, it makes sense to keep on investing that capital. If it falls below that levels, we pull up the handbrake. And so again, it's a return on capital decision on that capex side.
Okay, thanks, Jan. That's clear. So post capex, Megan, it sounds like you're happy with the level of debt in the business. So does the rest come back to shareholders as dividends? Or how do you think about that?
Yep, yeah, happy to take that question. And yeah, that's the way that we look at it, right? Is that we think earnings will continue to grow. If earnings continue to grow, those margins become much better as well. And the idea is that if we don't find the right projects to invest and allocate our capital, the only other place it can go is effectively returning it back to shareholders by increased dividends.
Okay, and then Jan, you mentioned the priority there is to pay down central debt at the RAC level.
Yeah, on the RAC level, the dividends we receive, the priority is to reduce those prefs.
Yeah, and then maybe I could just ask a question on LPMs, Megan. Is this a licensing delay issue, or I mean, what's been the sort of hindrance to? I mean, it sounds like you're parking a few machines. So what gives you confidence you can find 2,500 sites or 2,500 machines, shall I say, to place?
Yeah. So, the primary problem that comes around these LPM licensing sites is just the regulatory requirements about getting a site owner licensed. So, in terms of getting a National Gambling Board, it's now tax cleared certificates, zoning for the LPMs as well. So effectively, we're going to go put in 5 or 20 LPMs in a site. That site needs to be zoned appropriately to accommodate those LPMs. So even when you find site owners now that, want LPMs in their site and even do have all their tax affairs and financial statements, in order, we then have other municipal issues as well that delay the rolls of the LPMs in terms of rezoning or consent applications for those LPMs that unfortunately take prolonged periods of time. And, we've got teams that are dedicated just to sort those issues out. So I think that definitely there is that, appetite for site owners to get LPMs, in there. It's just the regulatory environment to get them licensed becomes, a problem. The other issue in terms of delaying of increasing the LPMs as well is that if we now need to increase our LPMs in a very good performing site, and we want to go from 5 to 20 or 5 to 40, which is a very quick way to increase LPMs and increase our overall revenue with our yield as well, is that it now goes through multiple processes. It now goes through municipal approvals as well, then it goes to provincial gambling boards, and ultimately goes to national gambling board as well. So if we have a process where you have a good performing site where we want to move from 5 to 40 LPMs, that's almost a 18-month to 24-month process before we can get those LPMs live. So it's a massive regulatory hurdle to get over.
Okay, thanks.
Yeah, look, I think the summary there is that to roll out limited payout machines is not a quick process. It takes time. Well, Alan's got a question.
Thanks, Jan. So, Megan, maybe just to follow on to that LPM rollout program. So I take it you do think there's scope to deploy an additional 2,500 machines. It's not as if it's more a case of the economics is there. It's just a case of the implementation and going through the operational processes of getting it done. Is that accurate?
Yeah, that's 100% correct. I think definitely we think there is a demand for the LPMs. I mean, at any one point in time, our LPM division is working between 500 and 1,000 LPMs. in terms of getting them, getting them licensed and getting them through that registry framework. So, and lots of them have hurdles at different points in the process. Either you have 200 LPM stuck at owners with tax clearance issues, which you're busy trying to resolve. You have 300 LPMs that are sitting at a hurdle rate of, municipal approvals to get over the line. You'll have 400 LPMs that are sitting at a national level that's been through a whole lot of, pre-approvals, gone through provincial, and now sitting at a national level, as well. So at any one point in time, there's 500 to 1,000 LPMs that are actively being worked on to get licensed.
Okay, great. Maybe just a bit of a different question. Jan and Piet, I guess. Obviously, RECM and Calibre has now morphed into something very different to what it was when it first listed. And in that context, I mean, is there any plan to revisit the control structure and or the management fee or anything along those lines? Is that on the agenda at all, or will it be business as it always has been on that front?
Yeah, I think we are looking at everything. Nothing is off the table. So we are looking at all the aspects of the current structure.
Okay, thanks.
And so I don't see any more questions. Let's go through the list. One more minute for any other potential questions. So I think in conclusion, by the end of October, we'll put out the half-year results. This will be on a consolidated basis. And then obviously going forward, this meeting, as we had it, Pref shareholders with executive management, will become more of a results conversation, as today's conversation was already gone, which is exactly the right way to go. So if there are any specific further questions you want, if I can ask, please send it to me. What we're trying to do is to shield Megan and Michael and Katlego and Mrs. N and everybody running the business so they can get back to doing that. And we'll collate and make sure you get the answers. We know there are a number of our shareholders that have a direct relationship. I mean, you guys know you're welcome to always phone anytime you want. So thank you very much for joining us. Thanks for the time. We look forward to seeing you again sometime next year.
Thank you. Thanks, Megan.
Cheers, guys. Thanks so much.